Good morning, everyone. This is Mike Mentor with Financial Synergies, and this is your market in minutes. And today we're looking back on last week, October 16th through the 20th, and it is Monday morning on the 23rd. So let's take a look at what happened. And by the way, I want to say if you're an Astros fan like me, I feel your pain. It was a rough game and probably a little bit of a hangover from that ending last night. But look, that's why they've got a 7-game series, and so fingers crossed tonight. And if you're a Rangers fan, I won't hold that against you. Anyway, let's jump right into it. All right, so what happened last week? It was a rough week, to say the least. Rising yields was kind of the continuing name of the game, and we'll talk more about that. But all across the board, unfortunately, pretty heavily down, as you can see. There was really nowhere to hide. But if we kind of broaden that out, of course, and look at year to date, luckily still very firmly in positive territory, especially in the broader markets. So still strong year overall, but it's been a tough couple of months. Now October up until this last week has been relatively okay. So we'll get into the reasons behind that. But so as I alluded to, rising yields really kind of sunk stocks, unfortunately, and this has kind of been the name of the game for the last few months. So stocks did rally to start the week, and then there was some really good positive earnings momentum, and then we lost that momentum when the news came out of rising bond yields. So yield rose after traders speculated that strong economic data might persuade the Fed to raise rates, which is still possible. Commentary from the Fed indicates that they're still pausing, but of course they are leaving room to raise rates, in the future. Now, whether or not they do that, who knows? And I still think they're probably on the tail end of this thing, rather than more successive rate hikes coming. So by midweek, stocks turned lower as a 10-year Treasury yield moved, above that 4.9%. Level, which is the first time since 2007. So it's a big move. But again, this is all this process of normalizing. It shouldn't be abnormal to have a 10-year Treasury bond yielding 5%. That's relatively normal. So we're just getting back to that over a very long period of very, very low, if not 0% rates. So mortgage rates hit 8%. That is shocking for a lot of people. Not exactly a bright spot for the housing market. So that has kind of turned things upside down there. And, that's indicative of one of those kind of economic indicators that, because, housing is such a massive part of this economy. And that's one of those indicators that could, lead us into a slowing of the economy and things like that. So it's something to keep an eye on. But again, this is to be expected when you're in a rate hike environment. So it's a little bit violent during this period, but we'll get back to normal. So stocks were definitely under pressure Thursday as a 10-year, again, moved closer to that 5% and in a response to Powell. So Fed Chair Powell, stated that inflation remained too high. So I think that's obvious. And with uncertainty in the Middle East, so this conflict in the Middle East, this war is still ongoing and horrific, and so that is now baking in additional volatility into the market. So, which is to be expected, but we'll get through all this. Okay, so let's take a look at the economic situation. Kind of nice segue from the last slide. So we had a lot of strength in some of these numbers coming out. But the housing was, continuing to weaken. The strength is a double-edged sword, right? Because while you want the economy to be strong, the flip side is that with continuing strength, the Fed is reluctant to take the foot off of the gas, so to speak, in terms of raising rates. So it's this kind of weird scenario where good news is bad news. So, the stronger that the economy is, it's unfortunately delaying the possibility of the Fed stepping back from rising rates. So it's a weird environment. We've been through it a million times. I mean, sometimes good news is bad. That's just the nature of economics. But that's the environment we're in. So the economy continued to show strength according to data released last week. And so despite worries of struggling consumers, these retail sales numbers are good. They actually rose 0.7%, well above this forecast of 0.3%. So in industrial output jumped 0.3. These look like teeny tiny numbers, but when you look at it on an annualized basis, it's pretty substantial. So that exceeded the forecast of a 0.1% gain. So housing starts rebounded 7% from August, but new permits. So this is indicative of kind of these new building permits declined 4.4% month over month, and that was a pretty big decline. So existing home sales were weak, falling 2% from August and falling 15.4% from a year ago. That's pretty dramatic. Existing home sales are on track now to record their slowest year since 2011. So, starting to see a few cracks here and there, but again, we kind of have to go through this cycle to get to the other side. There's just no other way out of it. So, in my opinion, the sooner we can get there, the better. Let's just get through it, digest this, and move on. So what's on deck this week? Key economic data here on the left. So Tuesday we have the Purchasing Managers Index. That'll be a good one to watch, PMI. Wednesday, new home sales. Thursday, gross domestic product, durable goods orders, and jobless claims. Friday, personal income and outlays, and consumer sentiment. So this is a big week, as you can tell, in terms of companies reporting earnings. We are clearly in right smack in earnings season. So we got a whopper of a week here, some big names. I won't go through these, but if you'd like to go back to the video, you can kind of see what we'll be keeping an eye on. But you got some massive names in here. I mean, Amazon, just to name one. But so these will be market movers to an extent. But so far, there's been optimism around earnings and continuing kind of strength in a lot of these sectors. So we'll see how it all plays out. But like always, we will digest this week, and we will report back to you next week on everything that's happening. Here's our contact information. Please give us a call or contact us if you would like to talk about your finances, or if you're a client and need anything from us. Of course, we're always here for you. And find us on YouTube down here, this little play button, if you're interested in just getting videos, sent right to you, notifications from YouTube, from the channel. You can subscribe. A lot of times we'll put videos out that don't necessarily find their way onto the blog or something. So that would be a kind of the only way to get that. So if you're interested, give it a shot. Thanks so much, guys. Here's a little disclosure for you to round things out. And we will see you down the road, and go Stros. All right, guys, y'all have a good one.